Phil Blancato. Phil, let's start with that, right? The big picture stuff here. Markets obviously held up pretty well. This is coming into the week, year to date, the month to date, down 5%. These other major oil impacts down 48%, 20%, 55%. So we know that at some point, lingering high oil prices can impact the market significantly. I guess the key is whether we have a recession or not.
It really comes down to, are you going to eclipse $120 a barrel, and when you do it for 8 to 10 weeks? If you do, we probably end up in a recession. At that, I still think a mild one. Let's not forget where the wealth is. We have the bulk of American wealth with people over the age of 65 who are still spending prolifically. And we don't, look, I grew up with 6% unemployment, we're at 4.3. I grew up with 4% inflation, we're at 3. So the reality is the U.S. economy is in much better shape than you give it credit for. Can it sustain this? Probably not for an extended period of time, but let's not forget, our BTU, price per, for what it costs for natural gas, is $3. What is it in Germany? $50.
Right. I mean, it's nuts. Totally different ball game with respect to that. Also, obviously, when you start talking about back in the 70s, some comparisons have been made to the oil embargo. The percentage, I mean, we've had the fracking miracle since then.
Right.
Let's talk about the Mag 7 miracle, or if it's still going on, because this has been the worst start, one of the worst starts for technology stocks. Interesting enough, 2025, the grade line there also was a really bad start. Again, though, after the taper tantrum, we rocketed higher, and we had a really good year for technology. There was a time when you told everyone, hey, scale out of tech and look elsewhere. Now you're sort of saying, okay, tech is looking pretty compelling.
You're finally getting valuations that are fair. Now, let's not forget, value stocks are beating growth stocks by 10% this year. So I'm not advocating you sell your value, but if you have some profits that you've made, you can go into the names now a bit cheaper, 21 times earnings, 22 times earnings. Still, this is where the AI disruption is important.
Right.
I don't want you to be in the companies that are going to be heavily disrupted. The companies that are going to make AI come to life.
You're saying more or less saying stay away from software for the most part.
I don't want software.
Right.
I want hardware. I'm going to talk about a couple names later. And the reason why, I think they finally got a price point that makes it a bit more traffic. If we get this war to end tonight, God willing, then we end up in a scenario where we get a real bounce in these names.
You had recently on the show, you gave us Broadcom.
Broadcom.
Huge deal with Anthropic. Stocks up big today, like last time looked $12. I would imagine you're still holding that.
I am. I mean, there's just too much more upside in this company. You hit on the beginning. You're looking at probably one of the essential companies in the middle of that hardware space that's just going to continue to benefit by the growth of that you're going to get, whether it's across the globe or in the United States or both. This is the company that's in the heart of it. And look at their earnings ratios. They're just through the roof still.
No, so last year we had sort of a changing in the guard. You had the OpenAI group and all of the names in that umbrella, so to speak, and then the Anthropic group with Google and a few other names. It feels more and more like almost every day these OpenAI names are struggling. Would you avoid those? Is it time to just bail out of OpenAI associated names?
No, there's no Coca-Cola of a large language model yet. No one has dominated this space.
Right.
So while I appreciate what Anthropic has done, I think
from 1 billion to 30 billion. Right.
And it's a lot to have to do with the federal government and the role they played there. There's a story here. They were the first to market. I honestly think the OpenAI story is yet to come. When you think about who's going to win this race, ChatGPT in and of itself and some of these other names we're going to talk about still have to find out their place in the world, whether they're retail, business, or both. Anthropic, I think, was more business first, retail second. I think that's what worked for them.
So this year is going to be huge with IPOs. All right, let's bring up. I can't even begin to explain how crazy it's going to be. You've got Anthropic, SpaceX, Anduril, Stripe. OpenAI, Databricks, Polymarkets.
Yeah, Polymarket.
And Kelsey, right? And they keep sort of jockeying for what's going to be the hottest one. I don't. What are you doing right now with respect to saying, okay, I want to buy these? What would you be willing at this point maybe to chase out of the gate, or would you have to look at them all individually?
One of my personal frustrations is that the overregulation of the public equity markets has caused us to have less stocks traded than ever before. So what happens is these companies stay private for longer. Why? Because it's really expensive to be a public company because of the regulation and the laws and the audits. So what's happening now, they're going to come out priced to perfection. You're not going to get SpaceX at a discount. You're not going to get, Kelsey's interested in me. Some of these names, Frontier Lab, you're not going to get this at a discount because they're all available in private equity funds. Right. So they've all been pushed up in significant valuations. What I would suggest viewers do, let it happen. And then come in 6 months, 9 months later when these really good names, which do have upside, sell at a 15, 20% discount to their offering. Remember Facebook back in the day?
Oh, yeah.
All that euphoria got crushed, and then you came down, you got a significant.
Yeah, I mean, it raised the offering price 3 times, and it raised the amount of money it raised 3 times, and then it went down 50%.
This isn't the days of
I'm afraid there's a Facebook ticking clock in that list we just looked. But let's talk about making money now.
Yep.
You still like SanDisk here?
I do. I just can't believe that we don't look at the obvious. I get it. It's up 1,000%. I get it. 200% in the last 3 months. But the company hasn't even met the 26 demand. They're just beginning to talk about the 27 demand. They're probably going to be sold out till 28. Why? Because there's only a handful of companies that do what they do. They got 60%.
You're not
margins.
worried about some algorithm memory killer lurking out there?
No, because a lot of that stuff to me is nonsense still. Here's what I would say. If we get a sell-off tonight, or tomorrow, going the next couple of days because of a traumatic event, buy this out a little bit cheaper. That makes some sense to me. But if you want to take a few percent of your portfolio, and I would call it a high-risk stock. It's not a low-risk stock.
Right.
But it's in a sweet spot that I think that demand is going to explode.
So to that point,
personal computers need this for AI.
To that point, many are calling this a super cycle.
Right,
For
exactly.
memory,
Exactly.
and this is Bank of America just a couple of days ago. You like also Micron then?
That's the winner. That's the one I want you to buy with both hands full of cash. Why? 40% earnings growth. You're talking about revenue growth that's almost uncalculable because of the demand cycle that they're in. Similar to SanDisk, different type of company, smaller company, I get all that. But they're the number one. They're the leader. They're the one that everyone's leaning on right now. Also, can't meet their supply needs. They're talking about earnings growth that we don't normally see with a normal company. Normal earnings growth are 8 to 12. We're talking 40 to 60. Margins, how much money they physically make, 30 to 40. This is just unheard of data.
Right.
So I get that they're expensive, but if you can buy them a little cheaper on sell-offs, I would do it.
Before I let you go, Kinder Morgan, I remember this was a hot name. This is back in the day when oil was hot. Everyone loved it, management or whatever. I hadn't heard it in a long time. Suggests to me that, okay, in this case, nat gas demand, whether the war ends tonight or not, that you see this being a real investable area.
The United States is going to supply the world with natural gas. These guys handle 40% of natural gas flows. They're a toll road. Don't get me wrong, they're not totally insulated from the movement of natural gas prices, but by the way, our nat gas hasn't moved at all. Why I like it, you get a 4% dividend. We're gonna probably double the amount of natural gas we need in the next 5 years.
Right.
Think of the data center demand, power. This is a way for you to be in a safer way in the energy space. I like commodities here. It's a great growth area. It's an easy way to be in a commodity market.
Dividend yield?
4%.
Yeah. I knew there was a dividend in there. Great stuff.